If you die tonight, your family could not touch a single dollar in your bank account. Not tomorrow morning, not next week. A will would not open that account for them. A notary stamp would not help. An attorney drafted estate plan would not move 1 cent. And the worst part is that the fix takes 10 minutes, costs nothing, and requires no lawyer at all. Most people have simply never been told it exists. I want to be clear about something before we go any further. I am not an attorney, and this is not legal advice. What I am is someone who has spent years helping regular people understand the financial and legal systems that affect their money. And the most preventable disaster I see again and again is not a bad investment or a tax mistake. It is a family standing at a bank counter the week after a loss, being told they cannot access money that was legally theirs because one simple form was never filled out. Let me tell you about a woman I will call Dorothy. She was 71 years old, a retired school teacher from Illinois. She sold the family home and walked into her local bank with $350,000 from the proceeds. She opened a standard savings account. Then she hired an estate attorney for $800, had a will drafted, witnessed, notarized, and clearly naming her 2 adult children, Michael and Sarah, as equal beneficiaries. She put that will in a lockbox under her bed and called Michael to tell him everything was handled. It was not. Dorothy suffered a stroke and passed away. Michael and Sarah flew in. The funeral invoice came to $11,500. Michael took the death certificate and the notarized will to the bank. The branch manager looked at the account on screen, looked at the will, and slid both documents back across the counter. Dorothy had never filed a payable on death beneficiary form. The account held only her name. Because her balance exceeded the state's threshold for a small estate, the bank had no legal authority to release a single dollar. A will is a letter of instruction addressed to a probate judge. It carries no weight at a bank counter. The account was frozen. Michael and Sarah walked out with nothing. They put the $11,500 funeral bill on their own credit cards, at interest rates running well above 20%, while $350,000 of their mother's money sat 20 feet away, behind a counter they could not legally cross. Then probate began. The court filing fee to open the estate was $389. A publication filing required by Illinois law to notify unknown creditors cost $250. The executor bond premium cost $1,000. And those were just the entry fees. The probate attorney charged a percentage of the gross estate, which is standard practice in many states. On an estate of that size, it came to over $10,500. There was a mandatory creditor waiting period that held the case open for months. From start to finish, the family waited 14 months to access their mother's money and lost more than $12,000 in documented costs along the way. Dorothy did nothing wrong. She had the will. She had the notary. She had the attorney. None of it reached inside the bank contract. Her situation was not an error or an accident. It was the entirely predictable result of a system working exactly as it was designed to work. Here is why. Back in 1969, a legal framework called the Uniform Probate Code was finalized by a national body of legal commissioners. Over the following decades, every state in the country adopted some version of it. What that framework established, and what courts have reinforced in case after case ever since, is this. Financial accounts at banks and credit unions sit on a completely separate legal track from your will. The contract between you and your bank governs what happens to your money when you die. A signed beneficiary designation on a bank form overrides a notarized, attorney-drafted will every single time without exception. Your will controls your furniture, your car, your jewelry, the physical property in your home. The bank contract controls your cash. If you die without a named beneficiary on a bank account, the account does not transfer to your heirs. It transfers to your estate. And the moment it transfers to your estate, probate is triggered automatically. Most states set probate thresholds between $50,000 and $100,000. If your balance exceeds that threshold, and for most retirees it does, your family waits. The court moves on its own schedule. And built into the law in most states is a mandatory creditor waiting period of 3 to 6 months before any distribution can happen, because unknown creditors have to be given time to come forward. Your family cannot receive a dollar until that window closes, no matter how clean your finances were. Now, here is something I want you to do right now. Pull up your online banking or grab your most recent bank statement. Look for a beneficiary field. If you cannot find one, or if it is blank, that is already your answer. Write down what you see. because what you find tells you exactly which trap you are sitting in. And there are three of them. The first is no beneficiary designation on file at all. This is the most common situation. You opened the account years ago, nobody at the bank asked you to name anyone, you signed the signature card and left. You assumed your will would handle it. Under the framework now codified in state law across the entire country, it will not. The account defaults to the estate and probate opens automatically. For a retiree with a $60,000 account, a 6-month probate process can consume a meaningful slice of that balance in fees before a single dollar reaches the family. And here is the part that almost nobody explains. If you hired an estate attorney to draft your will, they drafted your will. They did not file a bank beneficiary form. Those are two completely separate documents at two completely separate institutions. And the attorney is almost never the one to tell you that. The second failure point is an outdated beneficiary designation. This one is more dangerous than having no designation at all because it gives you false confidence. You named someone 20 years ago, maybe an ex-spouse, maybe a parent who has since passed away. That name is still on the form. That is who the bank sends the money to. Courts in every state have ruled consistently that the designation on file at the bank controls, period. The will in your lockbox does not override it. The third failure point is the joint ownership assumption. Many married couples believe that because they are married, accounts automatically pass to the surviving spouse. In a number of states, that is simply not true. Joint tenancy with right of survivorship is a specific legal arrangement that must be explicitly created and documented at the bank. Marriage alone does not establish it. And there is a trap hidden inside the most common attempt to fix this. Many seniors add an adult child to their account as a joint owner, thinking it makes things easier. The intention is good. The legal consequence is severe. The moment you add another person as a joint owner, the law in most states treats that money as partly theirs right now while you are still alive. If your child is sued after a car accident, the plaintiff can pursue your bank account. If your child goes through a divorce, their spouse can claim a portion of your savings in the settlement. If your child has a tax debt, the government can levy your account to satisfy it. Joint ownership transfers your exposure to every liability your child carries immediately and completely. Before I walk you through the exact solution, I want to tell you about something I put together that goes much deeper than any single video can. Everything we are covering today, the beneficiary designation rules, the 3 failure points, the forms you need at your bank and your brokerage and your retirement accounts, all of it, along with the exemptions and protections most seniors already qualify for but never claim. It is laid out state by state and form by form in the Hank Sullivan Retirement Protection Pack. You can get it through the link in the description below this video, or if you are watching on a screen right now, scan the QR code on screen and it will take you straight there. It is a serious resource built for people who want the full picture, not just pieces of it. Now let me show you the fix. Because the same contractual framework that froze Dorothy's accounts is also the mechanism that makes them instantly accessible to your family if you use it correctly. The form is called a Payable on Death designation, or POD. The principle behind it goes back more than 100 years and was codified in the Uniform Probate Code in a section that has since been adopted in some form by all 50 states. It is not a will, it is not a trust, it is a direct contractual instruction to your bank. And because it operates on that same contractual track, it bypasses probate entirely. The bank never looks at the probate court, it looks at the designation on file. When a valid POD is recorded and you pass away, your beneficiary brings a certified death certificate to the bank, the designation is verified, the transfer is processed, no judge, no attorney, no filing fees, no mandatory waiting period. Smaller banks often handle it the same day or the next business day. Larger institutions typically take 3 to 5 business days. What it does not take is 14 months. The cost of filing a POD designation is $0. Every federally insured bank in the country is required to offer it. Every federally insured credit union offers an equivalent. There is no fee to file it and no fee to maintain it. It costs nothing because it generates nothing for the bank. It serves only you and the people you name. Now, here's where most people stop and where most people leave gaps without realizing it. The POD designation covers your individual bank accounts. It does not automatically extend to every financial instrument you hold, even at the same institution. Certificates of deposit require a separate designation. If you have 3 CDs at the same bank where you filed your POD for your checking account, each CD needs its own form filed separately. Each account is its own contract. Brokerage accounts use a different form entirely, called a transfer on death designation, or TOD. It works on the same legal principle as a POD, direct contractual transfer, outside of probate, but it is filed with your brokerage firm. If you hold stocks, bonds, or mutual funds in a brokerage account with no TOD on file, those assets go through probate just like an undesignated bank account. Retirement accounts like IRAs, 401(k)s, and 403(b)s already operate on a transfer on death principle under federal law, but most people filled out their beneficiary designation when they first opened the account, sometimes decades ago, and have never revisited it. An outdated name on a retirement account can be worse than no name at all. Under federal law, the named beneficiary designation on a retirement account controls over any conflicting will or divorce decree. If your former spouse is still listed on an IRA you opened in 1995, they may legally collect the entire balance, regardless of what your will says, regardless of your divorce agreement, regardless of how many years have passed. Review those designations today. And one more asset worth mentioning, many seniors store their will, their deeds, and their valuables in a safe deposit box and give the spare key to a family member. That key grants nothing after your death. Banks are required to seal safe deposit boxes upon notification of a customer's death. Your family will be turned away even with the key in hand. And if the physical will is inside that box, they face a circular problem. They need the will to open the probate case, but they need a probate order to open the box. The fix is simple and free. Add your child as a joint renter on the safe deposit box contract at the branch. Both of you sign together and they retain access regardless of what happens to you. Social Security rules, tax thresholds, Medicare rules, and the laws around estate transfers change every year, and nobody from any government office calls to explain what those changes mean for your specific situation. That is exactly what this channel is here for. Subscribe and turn on the bell so you do not miss it when something shifts that affects you. Now, let me give you the steps to make this right before you close this video. Let's walk through this together, step by step. Step 1, go to your bank this week, in person, or through your online portal, and ask for the Payable on Death Beneficiary Designation form. Every federally insured bank is required to provide it. If the teller does not know what it is, ask for the branch manager. Step 2, name a primary beneficiary using their full legal name, date of birth, and social security number. Do not write a nickname or a vague phrase like my children. The social security number is how the bank verifies identity at the time of transfer. Without it, the payout can be delayed. Step 3, name a contingent beneficiary as a backup. If your primary beneficiary dies before you and no contingent is on file, the account defaults to the estate and probate opens again. Step 4, submit the form in person and request written confirmation that the designation has been recorded. Keep that confirmation with your important documents. Step 5, check every account separately. Your checking, your savings, and each certificate of deposit all require their own form. One filing does not cover all of them. Step 6, contact your brokerage and file a transfer on death designation for any non-retirement investment accounts you hold. Step 7, review your retirement account beneficiary designations and update any outdated names immediately through your plan administrator. Step 8, set a reminder to revisit all of these designations every 3 years and immediately after any major life event: a death in the family, a marriage, a divorce, a new grandchild. Tonight, your family still cannot touch that account. That is true tonight, but it does not have to be true next week. The probate system is not broken. It is working exactly as it was built to work. The pod designation is the one mechanism that operates on that same contractual track and wins. It costs nothing. It takes 10 minutes. And there is no reason to leave your family standing at a counter being turned away from money you worked your entire life to save. That one free form is the difference between 14 months of fees and waiting, and your family walking out of the bank in 3 business days with everything you meant for them to have. If you have already filed your POD, or if today is the day you are going to do it, drop a comment and let me know. I read every single one. And if you have a parent, a sibling, or a close friend who has never heard of a Payable on Death designation, share this video with them today. That 10 seconds on your part could save their family years of pain,